You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right. Well, we got a lot going on the last month, but let alone the last week. So we finally are seeing a little bit of a bounce back in the markets. Today we are taping with the market open. It is Wednesday, April 8th. You're probably listening to this on Thursday, April 9th. But right now the Dow is up about 2.5%. And the first time we've actually seen the Russell Index up more than the Dow and the S&P 500. The Russell Index is now up 46 points, we'll call it 4%. I'll round up to 4%. So, 2% higher than what the S&P 500 index is at and the Dow Jones Industrial Average. And I think that's a good sign for the markets. The small caps have really struggled, and a lot of that is just funding. Small companies need to have funding to keep going. There's been a big push from the government to try to keep small businesses alive, and the fact that the Russell is doing stronger is a real good thing. Then we also see right now that the VIX index is below 50. The VIX is still struggling to break that 40 level. Right now, we got the VIX right around 43%. And to me, 40 is kind of the new 20. And I kind of mentioned that on the stock play of the day this week, this past Monday, talking about the VIX index. I think a couple of big things have happened. I don't think that this stabilizes the markets by any means, but what we've had happen is the 20-day moving average has provided a lot of resistance to the upside. And we finally see the S&P 500 break through it, the NASDAQ broke through it. And if the Russell can actually close above it, I think those are some pretty good signs overall, just by looking at the general market. The fact that the VIX is at the 40 level is kind of weird, but we're kind of like, whew, some of the volatility has finally came out of the marketplace. We're going to have earnings coming, and earnings is on their way. So because of that, we're going to add some more volatility. But overall, which I find very interesting, on Monday, myself and my colleague Lindsay Bell discussed PayPal as the paper trade for the week in the stock play of the day. And one of the biggest things was that PayPal was going to be announcing earnings. And with that mentioned, we see that PayPal actually had implied volatilities way lower than they did. Well, the big market move was going on. And so it's kind of odd. It's like we're coming into earnings and we're seeing that implied volatilities are actually coming down leading up until this earnings, which is obviously an oxymoron normally. The only time you really see a ton of implied volatilities in fairly stable S&P 500 stocks overall is when they are going to be announcing earnings. So odd things are happening in the marketplace. With all that said, I also saw something that kind of inspired me this week. I actually, on CNBC, the CEO of Allstate Corporation was actually on there chatting it up. And Allstate today is trading at $96.64. It's up $4.11, or about 4.5% overall. But what they said is that they were doing to kind of add value or try to help out during this times. And their symbol, by the way, is all, which I kind of think is also very interesting. Just in general, we all got to get through this together. And they are actually giving back premiums to their customers, mainly because people aren't driving to work. And if people aren't going to work, the accidents have decreased across the board as far as car crashes are concerned. So because of that, they haven't had as many claims, and this is the way insurance companies are supposed to work. Now, I don't know ideally how much they're saving and how much they're going to give back relative. I assume that they're just going to probably going to take a little bit of that profit, but they're going to give some back to their clients, which that's the way insurance companies should work. In a utopian marketplace, if insurance companies charge you too much for your premium and the number of accidents is lower than what they anticipated, they should give you a rebate check back at the end of the year. That's the concept. That's the way that they should trade. But we all know they're publicly traded companies, and they want earnings, and they want to try to drive that stock price higher. So kudos to Allstate Corporation and their CEO, and because of that, that's going to be the stock that we look at today. Now, you can think about, once again, nothing that we talk about here is meant to be a recommendation overall. I just like the symbol, and I like that conversation that I saw on CNBC, and because of that, it makes you think about all the other insurance companies that are out here. But Allstate right now is trading at $96.65. It's basically $100 stock. So we have some premium in here, and if you would like to try to participate in Allstate, there's a couple of ways that we can do it. I'm going to give you a couple of just quick ways to think about the Allstate trade here. And if I'm looking at the option chains, they do not have weeklies, and Allstate wouldn't always be a pick of mine, mainly because the markets are a little bit wide in this volatile environment. But I do also see quite a bit of open interest relative to what there used to be, and we're going to be looking at doing a spread. And the way that I'm going to approach it, because they're thinly traded options, but I do like that they don't have weeklies, so it's feasible to trade them. We're just going to look at selling a put spread with the intention of hopefully buying the stock. I want to buy 100 shares of Allstate, considering that they basically came out and said that they're going to have a really good quarter overall. So what do we look at doing? Allstate's at 96.32. We're going to sell a put credit spread, but the concept here is that this is a fear of missing out trade. The markets are starting to rock. If I have money, when do I allocate? I've talked a lot about that, the FOMO trades, if you will, where, okay, I might not be willing to jump in, but for example, if a stock that I really like went a little bit lower, well, gosh, I wouldn't mind buying it. So why don't we sell some cash secured puts on stocks that we're looking to own and at least get some of our capital working for us. If the stock does bounce back and I don't get the chance to buy it, well, now I can just buy the put to close and go out and actually buy the stock. But if it does just kind of hang around and linger a little bit, at least I get some of that vol premium, and you're looking at really good premiums just overall. Like right now, if I look at Allstate, we're looking at a 50% vol on the at-the-money option contract. So if we were to just sell the 95 strike put, we could get, and this put is actually trading at a decent width on the bid and ask right now. So I could actually get about $2.50 on that. on that put for a 9-day option contract that goes out to April 17th, $2.50. Now think of that as if that was a dividend, how big that yield would be and what you would consider doing on a 9-day option contract overall. So $2.50 on a $96 stock, you're looking at bringing them about 2.5%. So fear of missing out. I can work for 9 days. If the market goes up from where it's at right now, after right now it's got a 4-point run up. So if the market goes on up, at least I'm making 2.5% on my money over the next 9 days. Now, if it comes down, I'm going to have protection. I don't really like selling a naked put on a $100 stock or a $96 stock in this instance. I would still prefer to have protection in this marketplace. And if you go down a little bit, it doesn't cost you that much. And I don't even really care if you're buying for, in this instance, we're going to look at a 5-point wide spread, but if I even went down and made it a 10-point wide spread, I just want to get some protection in this marketplace no matter what I'm doing. And I think that the insurance that you're buying further out of the money is cheap relative to the risk as far as a lot of these blue chip companies are concerned. So what is the trade? We're not going to go up far in time. We don't want to tie up capital in case the rally starts happening. We want to jump back in. So we want to be in a situation where if it does come down, we don't mind buying it. You got to like Allstate in this situation. The fact that their symbol is all, ALL. And we're going to sell the 95 strike put because we're really intending to buy it here and then buy the 90 strike put. Now, we got a little bit of a wide bid-ask spread, but the fact that we're approaching it as a spread should try to help us a little bit on the fills. And I've kind of seen their midpoints, well, unless the stock is literally just blowing through all prices going into the close, I've seen midpoint fills be fairly decent. And that's just because there is a lot of option activity, but the volatility has created wider bid-ask spreads. So if you come on in and you do a trade where you are giving them two legs, you're giving them a sell, you're giving them a buy, a midpoint fill is a little bit easier to do than just trying to buy a single leg option on contract outright. With that said, there's never a guarantee though. Okay, so I could sell that 250 strike put and bring in about $2.50 and or 2.5% on my option contract and saying I will buy the stock at 95 if it goes below 95. But in our instance, our paper trade is going to be we're going to sell the 95 strike put and then use some of that proceeds to go on out and purchase some insurance a little bit further down, about 5 points down. So the net credit to the account is going to be $1.67 overall. If I can get that done for $1.67, it means I'm just spending a little bit of that high premium to buy a little bit of protection here. Now, my max risk on the trade is going to be $5. So $1.67 minus the width of the spread, or $5, makes it $3.33. That would be my max risk. But my concept would be that I want to buy 100 shares of Allstate. So I would want to have $9,500 in my account if that stock gets put to me at $95. So in that instance, I want to be able to buy that 100 shares of Allstate. And this is maybe a time to allocate a little bit of capital. Or wait for the first round of earnings. They've just kind of started right now. There's a lot of big companies that are going to be announcing earnings over the next couple of weeks and see what happens with that type of volatility too. Obviously, until we find a quote-unquote cure for COVID-19, or there's some resolution, or some of the cases are starting to subside, it's going to be kind of a crapshoot as to when the market might actually start coming back, if it comes back at all, right? This might push us into a recession if we go long enough without having any answers to the COVID-19. All right, so I'll give you one last summary. I don't want to leave on that sad note. So fear of missing out. Think about selling cash secured puts to buy stocks you like. A little bit higher price stocks like $100 stock here, like Allstate. I would actually use some of the proceeds to buy protection. Still thinking I want to buy this underlying stock. I'm not going out that far in time. Here's the main reason why is that I just don't need to, right? There's so much premium in the shorter term options that is still left. Why do I want to go out and sell a month-long option contract when for 9 days I can actually sell an option that's just a little bit out of the money, get 50% implied volatility on a stock like Allstate, which normally would trade at around 15 to 20% implied volatility on a normal day. All right, so April 17th expiration, 9 days away. We're taping on Wednesday, the 8th of April. We are going to sell the 95 strike put and at the same time buy the 90 strike put. The stock is at 96.32. We're going to do this for a net credit to the account of $1.67. That means our max risk is $3.33. We got the mindset that we wouldn't mind owning 100 shares of Allstate, and we're going to allocate some capital. And at the very least, we want to try to bring in some cash instead of just keeping it all on the sideline and earn a decent percentage over the next 9 days on that capital. So that's it for this edition of Options Playbook Radio. If you have any questions you'd like to ask me, you can email me directly at theoptionsguy@invest.ally.com. Thanks for coming. Thanks for listening. And may all the options that you bought finish in the money and all the ones you sold finish out. Be safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.